Hello, investors. Amid an increasingly fragmented global sportswear industry with rising competition from emerging brands, Nike is currently being valued at a swoosh premium. The market is paying growth multiples for what is an increasingly maturing brand. We'd like to issue a sell recommendation with a $50 price target, implying a 12% downside from March 6th market close. Our thesis is predicated on the market's unrealistic implied growth expectations, a volume-based turnaround that limits margin upside, as well as structural headwinds within the Chinese market.
Since its inception in 1964, Nike has grown to become the largest sportswear brand in the world. Nike's main operating region is North America, which made up the largest portion of its revenue in 2025, but the company also has a strong global presence with over 50% of its revenue coming internationally. And Nike is a footwear company at its core, making up 66% of its 2025 revenue. This growth engine that once was for the brand is also where the company erosion is most visible. Footwear growth has decelerated across every geography simultaneously, which is not a regional story, it's a brand story. Nike's manufacturing is outsourced almost entirely to countries in Asia, consisting of Tier 2 and Tier 1 suppliers who work interchangeably to assemble finished goods before shipping them to Nike's distribution centers and ultimately passed on to consumers. This means that Nike is a price taker, not a setter. In the late 2010s, Nike pulled back from wholesale to go to direct to consumer, and the unit economics justified it. This is best explained by our interview with the former vice president of design creation at Nike. The problem with this shift, however, is that Nike burned those wholesale relationships to get there, and now they need them back. While Nike was pulling back from wholesale, the sportswear industry didn't wait. Challenger brands moved into the shelf space that Nike vacated. They built distribution, marketing infrastructure, and built consumer loyalty. Three things that Nike now needs to rebuild and recover. The result was shown in Nike's global market share, which fell from 17 to 15% from 2019 to 2025, while challenger brands collectively grew from 58 to 63%. A 3% loss in market share to brands that didn't exist at a meaningful scale a decade ago further represents this enhanced fragmentation within the industry.
Currently, the market is paying a growth multiple for a company that's delivering mature brand results. Nike trades at a 76% EV to EBIT premium over its peers, 16 points above its 5-year historical average. And while scale, strong brand value, and solid balance sheet certainly deserve a premium, the market price does not adequately compensate for the execution risk in the near term. At its current valuation, the market is pricing an execution that requires simultaneous Chinese recovery and full price restoration at DTC unit margins despite a wholesale-led recovery. To believe the current share price, the market is implying Nike can achieve 13.5% EBIT margins in the terminal year, a level reached only 6 times in the past 25 years when the company faced nowhere near the level of competition that it faces today. Nike's scale creates an illusion of leverage that it doesn't actually have. With $46 billion in revenue in the past fiscal year, to truly be the growth company that it claims, it must add the entire on-holding running company every single year. Its scale in manufacturing doesn't drive lower unit costs as pricing is standard across the industry, and its scale with wholesale partners drives placement, not pricing power, especially as partners have consolidated in recent years.
For our second thesis point, we believe that Elliott Hill's win now strategy is a volume-led turnaround rather than a return to brand premiums. The Vomero Plus launch proves that Nike can still create desirable products and sell at volume. However, this strategy will not lead to the margin expansion like the market expects it to. Operating margins remain constrained because demand creation expense is semi-fixed, targeted at 10% of revenue, which means Nike is still paying the full marketing cost to generate lower margin wholesale revenue. Additionally, the unit economics of Keystone pricing puts pressure on gross margins. Nike has also heavily relied on discounting to move its inventory, which has destroyed its artificial scarcity. Our expert calls revealed how much Nike relies on its artificial scarcity to build the brand, a strategy that the company is abandoning with this volume-driven turnaround. Without artificial scarcity, Nike does not have pricing power, which caps the company's margins. For our third thesis point, we believe that the market is dangerously overconfident in the Chinese market rebound over the next 12 months. Over 270 million Gen Z consumers are abandoning Western brand premiums for domestic value-focused brands like Li Ning and Anta. Nike's discounting in the region has destroyed its premium position in the marketplace. This has also inadvertently highlighted the superior value propositions of domestic competitors. We're also concerned around the declining state of the Chinese macro environment. A staggering 15% youth unemployment rate, falling real estate prices, persistent deflation, and increased oil supply uncertainty are all pointing to a weaker consumer spending environment. In summary, Nike's implied growth is highly unrealistic. Its margins are capped by a variable cost structure, and its largest growth engine, China, is fundamentally failing, implying a 12% downside.
Now I'll walk through the financial analysis, starting with revenue. We projected revenue using volume and ASP across each geographic and product segment. We expect growth to be driven by two key priorities: rebuilding wholesale relationships through volume and restoring Nike's brand premium through ASP, which account for 56 and 10% of incremental revenue, respectively, by the terminal year. Combined, these initiatives result in a 3.7% total revenue CAGR through 2031. North America has had the fastest recovery under the Win Now strategy led by volume growth. We project this level to stabilize in the out year with prices growing out of inflation. EMEA has recently begun the Win Now strategy, and we expect volume to accelerate in fiscal year 27 and return to historical levels in the terminal year. APLA is more fragmented with full segment recovery beginning in fiscal year 2028. Finally, China faces near-term pressure through fiscal year 2028, but then we expect to see volume to rise through the terminal year. Now looking at COGS, which consists of product manufacturing and distribution expenses required to produce and deliver Nike's products. Overall, gross margins face short-term pressures due to competitive marketplace and tariff headwinds. Into the terminal year, we project the gross margin on incremental revenue to be accretive to overall margins, leading to the terminal gross margin of 44%, in line with pre-direct-to-consumer level. Now, looking at operating expenses. First, demand creation. Demand creation includes marketing, advertising, athlete endorsements, and long-term sports contracts, and represents a critical investment to strengthen Nike's brand. This was projected as a percent of revenue, and after speaking with a former industry expert, we expect demand creation to reach the company's long-term target of approximately 10% of revenue. Next, operating overhead expense, which includes wages, R&D, admin, and tech. These expenses are largely fixed and are projected using a growth-based approach in line with regional outlook and overall company expansion.
Now moving into our valuation. Based on a relative valuation across peers in the global performance, lifestyle, and outdoor segments, Nike currently trades at a 51% premium on a next 12 months basis. Separately, Nike's implied EBIT multiple, based on its return on invested capital profile, suggests the company is also 43% overvalued.
For our intrinsic valuation, we utilized a price implied expectations framework to better understand the current market assumptions embedded in the stock price. In a projection period through 2031, we found that the market is pricing in a 4.3% revenue CAGR and terminal EBIT margins of 13.5%. The stock trades off its ability to expand margins. However, due to a volume-based growth shift and a variable nature of demand creation in the long run, we believe these assumptions are highly unlikely to materialize. We utilized a probability-weighted DCF, assigning equal probabilities to our bear case of $40, a bull case of $70, the largest probability being given to our base case of $47. The bull case simultaneously requires China recovery ahead of schedule, gross margin expansion to 45%, and demand creation leverage, all of which we find improbable independently. Relative to the market, in our base case, we are modeling a slow recovery in revenue and EBIT margins before stabilizing in the out year. And in the short run, discounting and a return to wholesale pressure gross margins, while demand creation acts more as a fixed expense. This combination leads to revenue changes affecting margins more than the market is currently anticipating. We wanted to give weight to the other cases as there is some credence to their outcome, and we still derive the $50 price target, which is a 12% downside from the current share price. Nike's asset-light business model and strong brand value allow for an industry-leading return on invested capital. As such, we derived a 3.5% terminal growth rate from its fundamental determinants of growth, return on invested capital, and reinvestment rate. We derived a weighted average cost of capital of 9% based on Nike's 97% equity capital structure, currently holding more cash than debt in the balance sheet in the last fiscal year.
To evaluate Nike's ESG quality, we created our own proprietary ESG scorecard. After taking into account the key SASB issues of material sourcing, product quality and safety, and supply chain oversight, we found that increasing supply chain scrutiny and compliance costs will result in cost of sales increasing by 10 basis points. With net zero targets by 2050, Nike still has room to improve through its manufacturing and transport emissions. The company excels at brand inclusion, encompassed by the motto, "If you have a body, you are an athlete." Nike properly incentivizes Elliott Hill with over 93% of his compensation being performance-based. We do have concerns around board independence, however, as Class A shareholders have majority of the board's votes.
So despite our confidence in our sell recommendation, we've identified two risks that we believe are still worth addressing. First, our projections assume incremental tariff costs and cost of sales, but if tariffs are rolled back, Nike's gross margins could expand by roughly 3% annually. Second, an expedited China market stabilization could strengthen the turnaround narrative in a critical growth market that could drive top-line revenue. So with that, we'd like to reiterate our sell recommendation. Thank you again for your time and attention.